the usage of this on the usage of the report, as well as the state of the market. And for that, we have a great lineup of speakers today, including Geneviève Edens from Water Equity, Fernando Sanchez from Beam Investments, and Per Van Sway from TCX. So I'll let them introduce themselves during the panel session after my presentation. And then we'll leave a bit of time at the end for the Q&A session with the audience. So I invite you to use the Q&A function to type in your questions, and then we'll cover them to the most extent possible towards the end of the session. So let me start by sharing my screen and present you some takeaways of the report. Great, so should work now. I'll go directly to the first slide. So a bit of background on the study itself. So the report, it informs on impact investing strategies in private markets through funds that focus on emerging and frontier markets. So as you can see, this is a very niche subsegment within the broader impact investing space. And we believe at Tameo that this is what distinguishes this type of report with other industry initiatives that inform on the state of the market. So when we put together this survey back in 2020, our idea was to provide the industry more transparency and data points about impact fund products beyond microfinance funds, because we used to do a lot of annual surveys on MIVs, the MIV survey, as you know, with Symbiotics. So we thought it was the right time also to provide and start building benchmarks on other fund products. So what we did, we started putting together new questions on what makes sense on different types of sectors. And we got the lead sponsorship from the SECO, the Symbiotics, and TCX for the second edition, which enabled us to drive this industry initiative and market transparency function. And a big thanks to all of them, obviously, and also the 18 co-sponsors that you can see here, without whom this type of industry initiative wouldn't have been possible today. So onto the study itself, I'll start by giving a bit of overview on the market size that we are talking about in the report. So as I said, our focus is on impact funds. So it is a subset of impact investing. Today, the impact investing market is sized at $715 billion US, according to the latest estimates from the GIN. And at Tameo, what we do, so we start with this figure and we go down market. So we start with 715 billion and we remove all listed assets. So we only focus on private asset investments. And then we also remove all investments that flow through developed markets. So we only focus on emerging and frontier markets. And from there, we look at public and private sector investments that flow through specialized impact fund products. And this is where you can see the small bubble at the very bottom of 38 billion. So this is the size that's estimated by Tameo today. It's composed of over 500 private asset impact funds actively investing in the market today. And they are run and affiliated to over 270 investment management companies. So when we started the survey in 2021, in the summer months, we reached out to all of these 270 plus investment management companies, and we asked them to report data on both the financial and impact front side of the funds that they were running. So that was a lot of outreach to the market, and we were able to aggregate a sample size of 175 impact funds. And in fact, this is a record year for the PIFE report, and we are very happy with that. In terms of AUM, this covers approximately 2/3 of the 38 billion market size. And if you take within the sample, only if you look at the microfinance funds, our coverage shoots up to 92%. Obviously, for Tameo, the idea over the years will be to replicate the same high coverage that we have today in the microfinance funds industry to the broader set of impact fund products. But that will obviously take time. We need to build track and data continuity. So we have a good start here with this report. The table on the right gives you a bit more context on the sample characteristics. So we've segmented the analysis by peer groups, two main peer groups. So asset strategy, fixed income, mixed, and equity funds, and primary sector of investment. So you have here all the sectors that are available in the paper. Why do we do that? Obviously, our fund universe is very diverse. So to be able to compare one fund product to another across multiple indicators, it makes sense to really create these smaller pools of peer groups. So here you can see that out of 175 funds, 101 are fixed income, so they do private debt. 34 are mixed funds, so those are the funds that have both private debt and private equity investments in terms of instruments, and then private equity funds who are 40 out of 175. And in terms of sectors, microfinance funds form the bulk of the sample, 92 funds today, with in fact a 92% coverage of in terms of AUM, as I mentioned. A bit on the size of these peer groups in terms of total assets. So on the very left, for all funds, you can see at the end of 2020, one fund from the sample sizes as at $141 million in total assets. And then you have variations across the sector and by asset strategy. So microfinance funds are the largest in size, as well as fixed income funds, and comparatively health and education funds are the smallest, and private equity funds are the smallest on the asset strategy side. A few words on the growth that the market enjoyed in 2020 and the forecast for 2021 in terms of total assets. So 2020 was a flat growth year for private asset impact funds. The market grew by a tiny 1.5%, which is unusual, but it's very much linked to the COVID-19 pandemic. And if you look at microfinance funds specifically, they even shrank in size in 2020 by 0.6%. 2021 forecast by fund managers who participated in the survey shows us that it's much brighter in terms of AUM expected growth. It's double digit across all sectors, across all asset strategies, and to be more concrete, it's 12.3% expected for all funds and 10.1% specifically for microfinance funds in 2021. Now, if we focus on the portfolio of these funds and where they are allocated, so I'll start now by sector, and then I'll go into the geographies and the investee types in the next slides. So by sectors, you can see here that 52% of portfolio flows from these funds into microfinance activities. And this is natural given also the high proportion of microfinance funds within our sample of 175 funds. But still, it also translates the market reality because we know that microfinance investments are the most mature sector within impact investing today. And the second most attended sector is SME development at 24%. And again, this is a natural shift beyond microfinance to SME finance within the whole narrative of financial inclusion. And then you have food and agriculture, which captures 8% of portfolio flows, and then climate and energy sector, 6%. A bit on the region here, segmented by primary impact sector of focus. If you look at microfinance specifically, you see that the funds, the MIVs, basically they have 50% allocated between Latin America and the Caribbean and Eastern Europe and Central Asia. It was always been the case historically. There were very strong markets for MIVs, but we see also high growth happening in South Asia. And now today the allocation is 15% at the end of 2020. And there are various interesting contrasts. If you segment the analysis by sector, you can see that health and education funds are highly exposed to Sub-Saharan Africa, for example. Or another example is that housing, water, and communities funds are more exposed to Asia, be it South Asia or East Asia and the Pacific. A bit on the investee type. Here on the very left of the bar chart, you have the results for all funds. Here we look at whether the funds, they respond to their impact narrative by investing institutions in domestic markets, or they do direct investments into SMEs larger corporations or project finance. So we can see that 85% of portfolio flows through financial institutions today at all funds. And then you have, again, contrasts between different sectors, but most sectors still flow their money through financial institutions. In the food and agri sector, there's a lot of usage of direct SME financing, whereas in climate and energy, for example, 14% is in project finance. Now, I'll focus a bit on the private debt instruments because private debt is the most used instrument when compared to private equity, for example. So here you have two pie charts. The one on the top left shows you the breakdown of private debt portfolio between senior and subordinated debt. So most of it remains in senior debt today at 91%. And then the second pie chart shows you the currency type of investment. So most of the lending from these funds happens in hard currency, 65%, and 35% in local currency. And this can raise the questions on the risk mitigation and the risk transfer of these funds, the currency risk transfer that happens to the investee and eventually to the end beneficiary, given the high level of hard currency investments. But we can tell you that the local currency investment at 35% is a number that's increasing over the years, especially in the microfinance fund space. And we know that this is also thanks to availability of hedging products for fund managers to be able to mitigate the risk. And we can talk a bit more on that during the panel discussion, namely with TCX. So here a small table on the top currency exposures of these funds. You have the USD, which is dominating, obviously, but then the Indian rupee has more exposure than the euro, for example, and then it's completed by the Mexican peso and the Indonesian rupiah in terms of top 5 currency of investments. A bit on the net returns and the market sentiment for 2021. So here we show you median observation for the sample. And again, given the diversity of the funds and the different approaches, the way they are structured, the types of investors they have, it's very difficult to simply give one figure and say, okay, this is how the asset class fares. So we need really within the report to really segment the analysis. And here we've decided to segment it by leveraged funds at the bottom of the table versus unleveraged funds. So the leveraged funds are the ones that make use of some types of borrowings to finance their assets. So they're a bit lower in terms of number, in terms of sample size. So for them, we ask them to report the coupon returns that are enjoyed by the note holders, and it's 3.3% at the end of 2020, lower than 4.9 in 2019 in US dollars. And then if you look at the bulk, so the unleveraged funds, you can see again, it differs by strategy, but across the board, 2020 was a much more difficult year in terms of financial performance. And this is naturally linked to the COVID-19 pandemic. And also given that 2019 was in fact a very strong year for impact investing. So in 2020, returns have been lower, but still relatively resilient. If you look at the figures, especially for fixed income funds in 3 currencies, it's positive. It's not necessarily the case for other types of strategies, but it varies, and we need to contextualize also where those funds are invested, in which type of countries, in which type of instruments. So then a bit on the market sentiment on the pie chart on the right. Here we asked the fund managers whether they expect their funds to perform better than 2020 for 2021. And similar to the rebound that we are forecasting to observe in terms of size of funds, it's also the case for net returns. So there's a good market sentiment where 2/3 of the funds expect an increase in their net returns in 2021. And even 19 of them expect a high increase in net returns. So we have to see how this translates in reality at the end of the year. And then a couple of results on the social and impact side, which is obviously very important. Here on the left, we show the SDG intent of this fund. So we map how many funds map their goals to the SDGs, and we see that goal 1, 8, and 5 are the most attended ones by private asset impact funds. And then on the right, we have some result at the outreach level. So how many end clients are financed at the median observation at the fund level. So again, these are the different types of outreach approaches that we can ask to the funds to report on. So at the aggregate level for all funds, the median observation is 146,000 end clients reached. And then you have variations across different sectors. So that's it for me. It was a really quick overview. Obviously, you'll see in the report that it's much more granular. You have more than 300 fund level indicators in the report with detailed market trends. So I invite you to access and download the full report here at the website. For any questions you have on the publication, you can write to the Tameo team, paif.survey@tameo.solutions. So without further ado, I think it's very nice to welcome our speakers today. So I'll be moderating the session. We have 35 minutes. So I let the three speakers introduce themselves. I stop sharing the screen and we can go live. So I'll start with Geneviève, and then Fernando, you can present yourself, introduce yourself, and then Per. So the floor is yours, and I'll stop sharing the screen.
Thanks, Ram. Hi, everybody. I am the Director of Impact and ESG at Water Equity. We are an asset manager based in the US. We invest exclusively in water and sanitation. And I'm really excited to see this report coming out. We've been a big user and supporter of this report in years past, so glad to be here.
Thank you, Geneviève. Fernando?
Well, I would like to thank Tameo, Ram, and the entire team at the European Microfinance Week for this opportunity. My name is Fernando Sanchez. I have 24 years working in the fund management industry, and especially in the impact investments that seek not only economic return, but developmental results. At Bing, we had a chance to develop and launch more than 20 funds designed for motivated investors. We were able to fund more than 75 microfinance institutions in 14 countries in Latin America and the Caribbean, and to give technical assistance in several areas, including digital transformation. Our flagship is called LogFund Next, that aims to provide more than $800 million loans to microfinance institutions in local currency. LogFund Next is created after the successful conclusion of its predecessors, LogFund 1 and LogFund 2. In addition to the microfinance sector, we recently launched Innovasol, a clean energy facility focused on photovoltaic solutions offered to medium-sized companies. Well, congratulations for the research on private assets impact funds. And now we are ready to start a fruitful discussion round.
Thanks, Fernando. I think we'll touch a lot on the local currency side and also the non-microfinance products. So looking forward to it. Thank you. Hello, Per.
Yes. Hello, Ram and co-panelists and everybody else. So my name is Per. I'm with the TCX Fund. I've been with that fund for 10 years. The fund itself has been around for 13, 14 years. We have one purpose in life, and that is to hedge currency risk wherever the commercial banks are not yet doing that. And we probably work with some 150, 60 DFIs, impact investors, helping them provide local currency debt in situations where they need to hedge it. Not everybody hedges, of course, but when lenders, for whatever reason, need to hedge, we are around to make that work. And it's not just us. We work, of course, with MFX solutions that many of the funds that have been surveyed for this survey work with. MFX is an important intermediary, so they operate as an intermediary between us and many of the smaller impact funds. But collectively, we service, as I say, some 150 plus impact investors globally. That's about that's us, Ram.
Thank you, Per. So I think I'll stay with you on this one. So I wanted to start a bit on the local currency exposure, of course. So in the report, we see that the funds in total cumulatively, they invest in 64 different local currencies, which are considered some of them thinly tradable and high risk for some investors probably. But still the volumes allocated, despite the high number of currencies, the volumes allocated remain highly in hard currencies at 65%. And does this result surprise you? And why isn't there more local currency exposure within lending funds, so debt funds here? And what factors could enhance the use of local currency lending by these funds to mitigate their risk at the beneficiary level as well? And how can TCX, position itself to help them with that?
Yeah, there's a lot. There's really a lot in that question. I mean, look, the fact that you have, first of all, you have all sorts of different funds. Funds differ in the sectors, of course, that they lend to. Some sectors generate exclusively local currency. Some sectors generate dollars. A lot of the lending goes through financial intermediaries. If the financial intermediaries themselves are banks, which may have both hard currency and local currency sources of funding, hard currency and local currency assets, then banks themselves may very often be able to hedge. So it doesn't necessarily mean that a hard currency loan is the wrong product. So you have to begin with qualifying really who are the funds and who are they lending to. And in many instances, a dollar loan might be the appropriate product. So it begins with that. It's very hard to say that all hard currency debt is the wrong product. So having said that, if you do look at that funds, there's a few further distinctions I think that need to be made. But if you do look at funds that lend to sectors that exclusively generate local currency, or that lend to financial intermediaries that exclusive operate with local currency, then you would think the principle should be local currency assets. That is our mantra, our mandate should always be financed with local currency debt. I think that there are strong empirical arguments to suggest that that is the best option, and also not a more expensive option. Of course, there's this perennial discussion around price. I think very, very generally, we can state that if you look over long periods of time, the comparison of the cost of hard currency with the added cost of depreciation is very similar to the cost of local currency. So if you would have an infinite horizon, if you would be borrowing for 40 years, you should always be borrowing in local currency if you're a local currency business, because over time it shouldn't make much difference. And then obviously you will opt for the lower risk products to protect yourself against volatility and shocks. I think what the problem is in practice, that certainly where borrowers are not necessarily committed or compelled to borrow in local currency, but have the choice, for example, in off-grid energy or maybe in agri. These are not financially regulated sectors where a borrower can choose between hard currency and local currency. Then it becomes tricky and interesting, because that logic, that over a 50-year horizon, dollar loans and local currency loans are very equivalent from a pricing point of view if you factor in depreciation. That may not resonate that well with somebody who's borrowing for 3 years. And if you're an MFI that has the ability to borrow in hard currency or local currency, you have the freedom to choose. And you're looking at a hard currency loan at 8% and a local currency loan at 18%, or you're an off-grid company or somebody in that type of sector. That's a tricky proposition, and there's always this tendency for businesses to focus on the interest rate difference and to choose the dollar loan with the 8% interest rate, thinking or believing or hoping perhaps that over time is going to be the better or cheaper choice. And sometimes for individual borrowers, that may be a legitimate transaction. From a risk management point of view, it may be a legitimate gamble. And in certain currencies, of course, is widely different pricing versus depreciation stories. You may be working in a currency, I should say, that over the past couple of years has been extremely stable, shown very little depreciation, while hedge rates are still relatively high. It's a difficult decision, whilst you may be operating in a currency that shows the exact opposite, whereby it is a total no-brainer that you would borrow in local currency. So I think the whole story needs to be, you need to be quite nuanced when looking at it. I think what remains a problem, though, is that I think there's still, and it also, the survey also shows that I think there's still, generally speaking, quite a lot of misunderstanding or misperception about either the risk of currency risk, the magnitude of the risk and the impact that it can have, and on the other side, what is the actual real cost of local currency compared to dollar funding. There continues to be, I think, misunderstanding around it, and I think that's, I think that is where the challenge is for us as a hedge provider with a development finance impact and a development mandate, is to continue to be around and to make the product available to whoever may need it, and also to listen. And then I'll conclude, by the way, to listen to what the industry has to say and what the concerns are and what the needs are and what the also to be able to respond to what the industry needs to make their or more suitable. And obviously, the easiest thing to do would be make it more cheaper. Unfortunately, we don't always have that ability. We have been looking at programs where we make it, the local currency alternative, more attractive with donor support, and that's something that we'll continue to be looking at over the years. To encourage individual borrowers to go for local currency so that you build stronger sectors as a whole. So definitely something we're doing. And I think also this interaction with you, our role in the survey, bringing out questions and comments from the industry. The reason we do it is not because we want to per se to do more deals, but we really want to hear from the industry across a wide as possible segment or a cross section of the industry. So what are the issues? What can be done better? Should we be focusing certain aspects to increase the share of local currency in overall impact lending?
Great. Thanks for this very complete answer. There's a lot of things to digest here. So an interesting point is, obviously that a lot of it flows through financial institutions, as we saw, and as you say, many of them can be larger banks who have the ability to absorb, US dollar hard currency investments. Yeah. It could be interesting to look at whether there are contrasts compared to direct investing into smaller enterprises and things like that. So, but on that note, Fernando, BIM, as you say, you have more than 20 years of track in managing these impact funds, position in financial inclusion. And as you said that during your intro, a lot of your funds products are providing MFIs with loans in local currency. So MFIs, we look at financial institutions here again. So is it similar to what Per said, and how do you approach this FX risk dialogue at fund level with your investors, and how is it also with your investees, obviously, and the end beneficiary?
Okay, thank you, Ram. We can divide the approach to our investors in three parts. First, together with investors, we developed what we call the local currency diversification model. It's not very complex. It's based on diversifying in at least 10 currencies that are not highly correlated among themselves. Latin America and the Caribbean region is able to show this type of diversification because its economies are in general diverse. For example, in South America, we have mineral, oil, and gas producers with large interaction with Europe and China. But on the other side, we have countries in Central America highly correlated to the US economy via services, remittances, or other. Therefore, there's a good and diversified combination of countries. Other aspect of the model is that we work with variable interest rates in each country and also avoiding high concentration of repayments in one point in time. We also need a long-term view rather than any type of speculative strategies. That's the first part. The second part is that we propose to the investor a deep knowledge at the country's level and at the investee level. In other words, a local approach, but a real local approach. I'm not talking about opening an office in the region. I'm talking about coming from the industry, knowing the trends, and living the day-to-day business in those countries. It helped a lot to reduce not only the FX risk, but also the credit risk. The third aspect is related to the investors we approach. They are largely, I have to say, sophisticated and with high quality in general. I'm talking about Northern from Norway, FMO from the Netherlands, BIO from Belgium, CFM from Switzerland, IDB Lab, IDB Invest, DFC from the US, OEB from Austria, and Google, for example. Therefore, we strongly think that part of the positive results are due to the type of investors we had a chance to attract. Finally, despite the experienced crisis, for example, the 2009 global financial crisis or the pandemic's crisis, we were able to show positive results for the last 15 years because of a combination of a portfolio return much higher compared to our peers, together with a relatively small FX effect. This FX effect is somehow what Per just explained us as a cost of having local currency versus US dollars or hard currency portfolio. So therefore, that combination gave us a very interesting result. That's why LogFund Next, our latest investment vehicle, is positively evolving and will triple the size of its predecessors, always in line with ESG standards and protecting the most vulnerable population.
Great, thanks so much. It's glad it's working and able to grow your products as well, Fernando. And so you have the LogFund products, which are basically positioned in financial inclusion, microfinance historically. But we know that you have also products outside of the microfinance space. And this paper, given the emergence of these types of impact fund products, not only developed by specialized impact investing firms, but also by historically microfinance fund managers who are proposing today to investors different types of approaches in impact. We see that today microfinance still captures, 52% of portfolio flows by these funds, and it's a natural leader in the space. But what about, renewable energy? In your case, Fernando, or water and sanitation, in your case, Geneviève, how do you see both of you, your respective markets faring in the coming years in terms of growth? How able will it be to, maybe it's a bit early, but to catch up, slowly on also other types of financial inclusion approaches? Maybe Fernando, you can start, and then Geneviève on the water and sanitation side.
All right, thank you. Well, yes, you're right. Microfinance is growing and positively evolving, but more than 200 million people in Latin America have no access to any financial service. The financial inclusion gap is still there, and we need to reduce it. In parallel, of course, for example, the demand of clean energy solutions will increase over time. But I have to say that it's on our side to develop the market and show results. As managers, we should not only try to follow a trend. we have to see first our own skills before the next steps. For example, we have more than 20 years in microfinance sector, and that's why we feel comfortable by offering tools to improve that industry. On the other side, in BIM, we are part of the Pan American group that has plenty of experience in clean energy, developing and operating energy plants in our region. Consequently, we consider to launch a new facility focused on clean energy. I mean, the conclusion is if we can specialize and present profitable and efficient opportunities in the market, we will be able to contribute to a successful industry growth and also to comply with the Sustainable Development Goals.
Yeah, great. Thanks, Fernando. How about you, Genevieve, water equity?
Yeah, no, I agree with Fernando's points there. And thinking about water and sanitation, the way that microfinance has really scaled up and become a mature impact industry is what we're looking to see across all these other sectors. And none of them has gotten there quite yet, but I think there's a lot of potential. We see a lot of investor interest on our side in water and sanitation. It's growing, I think, because of the pandemic. It really highlighted the gap that exists globally around clean water and safe sanitation. And if you look at the GIN's annual impact investor report, WASH, or water and sanitation, has been an area where investors have been intending to allocate additional capital to. But as you can see in this the Tameo survey, the results it hasn't actually resulted in opportunities for them to invest, or there are not as many funds active in this space as we think there is opportunity and interest. So there's this gap, and that's what water equity is really hoping to solve, is demonstrating the opportunity within water and sanitation, bringing investors alongside us, and encouraging other asset managers to identify those opportunities as well. But I think compared to microfinance, there's a lot of structural gaps that exist. With water and sanitation, so much of it is related to local regulations, local policy around private investment. And on the impact side, there's been such an infrastructure built up for microfinance investors. There's common standards for thinking about impact and ESG and risks, and those are lacking in other sectors. So I think there's a need to kind of build from the ground up in a lot of sectors.
Yeah, indeed. Thanks, Genevieve. It's good to know, the room for growth in these specific segments. But you mentioned that it's we can see in the report that the strategies in water and sanitation are very low compared to other types of funds. So I guess water equity within your small niche, you're a leader, obviously, but how difficult is it for you, obviously, to compare in terms of benchmarking your business operations? And as you say, maybe an industry effort is more needed across working groups, networks, or maybe more public support to increase private allocation. Is a blended finance solution the approach, or how do you see things going in that side?
It's a great question. I was really struck by one of the slides that you presented that showed the types of borrowers or investees that your fund managers are allocating capital to, and that the vast majority across every sector is through financial institutions. So even within the water and sanitation vertical, the money's flowing through financial institutions. And I think what would be really interesting is thinking about impact investing, not just thematically, but also based on those borrowers or investees. So thinking about that small segment that's project finance in clean energy, and water equity, we're growing we have a small footprint in SME investing, and we're looking to grow there, and then also in project finance, but it's a whole different set of standards. And in thinking about industry standards, but also benchmarking, I think there's a lot of potential there for learning and sharing best practice.
Yeah, indeed. And on that side, on the project finance side, as you rightfully pointed, it's still scarce today within at least our view of private asset impact funds. But how does water equity, and maybe also Fernando, you at BIM, these infrastructure investments basically in the risk return spectrum from an investor point of view, how do they sit comparatively to doing, financial institution and then flowing to the money through earmarking to climate and energy or through water and sanitation microloans? How do they compare on that? And is the impact approach key here to say, okay, I don't know, maybe is it more impactful to do direct rather than to financial institutions? And how do you put this message to your investors when you promote the funds that you manage?
Fernando, do you want to take that one first?
No, please, ladies first.
So I'll speak on the impact side because that's really where I mostly focus. And, it is a very different risk return profile. And on the impact side, it's quite different as well. Like the way that we're benchmarking. So one thing that I like a lot about this report is that it's not separating the impact and the financial returns. It's considering both elements together, which I think is unique. For microfinance, I think it's a lot easier to compare investments to each other around impact. There's a set of standards that exist. There's often a similar profile in terms of the way that you would track your impact as an investor. But when it comes to project finance, it's hard to compare those apples to oranges. The way we think about it, because we have a significant portion of our portfolio allocated to financial institutions that are then on lending for water and sanitation. So it's a lot simpler to then go and track, how many, for example, toilets were constructed as a result of our investment in a particular MFI. When we start investing in sewerage networks or sewage treatment plants, it becomes more complicated because you're looking at an entire system, looking at both the environmental and the social impact of that investment in a way that is quite different from an individual using their loan for a specific purpose. So thinking more systemically, I think is important. And I wonder if, with some of the regulations that have emerged in the EU in particular around climate reporting and the importance of sustainability reporting, if the impact investing industry that's focused more on the project finance should consider ways to adapt some of those metrics for our sort of common benchmarking purposes. It's not a perfect system, obviously, but I think where there is no common taxonomy, it's helpful to start somewhere.
Oh, great, thank you. I have to be in line with Geneva words. In addition to that, talking about microfinance, I have to say that definitely on one side we have metrics and a methodology to evaluate the institutions, but on the other side you have plenty of institutions that are needed in some specific areas, rural areas, or in some countries where definitely the financial inclusion gap is very high. So therefore, now in that moment you start to see the stress of investing on a institution that is on a inflection moment, or basically on a startup. So therefore, you have different levels of risk return approaches in microfinance also. In other words, definitely the way you have to approach this industry is not very strict in terms of specific methodologies, benchmarks, etc. At some point, you also have to be, I don't know, close to a project finance approach.
Yeah, true. And I mean, the local context, everything is different from one project to another, and it's always the challenge of finding the right comparison tool, because everything is very diverse in our market. But hopefully things like the report can give some guidance as well as other industry standards, obviously, in the microfinance space. So maybe to you, Per, in terms of the people you work with, the fund managers, do you see this shift a bit of on their operations from financial services financing towards more direct lending, and you have appropriate products, I guess, yes, because it's on a transaction side. But if you can give a bit more insights on that, that would be great on how you see the shift also.
Yeah, thanks. Well, I mean, from us, what we still see is that the impact funds that we work with it's also largely dominated by microfinance lenders and therefore microfinance institutions as borrowers. So microfinance makes up a huge part of what we have historically always been doing. The other big taker of product and is SME banking. So again, these are funds or other impact investors lending to SME banks in local currency. So that is still by far the biggest taker of local currencies that we see. We do see much less, but there's also increasingly lending in local currency happening to the off-grid sector, so the distributed renewable energy sector that we mentioned. So that is impact investors lending directly to corporates, so bypassing financial intermediaries, which is a local currency sector, and what we see is still very much a mixed bag, where some borrowers are choosing currencies, some in local currency. That relates back to the discussion that we were having earlier, and where we are, that it is for an unregulated borrower. It's always a tough decision to choose for local currency over dollars because of this focus on the interest rate differential. But luckily, we are seeing that sector growing and the share of local currency finance also increasing. Where we see much less local currency happening is in project finance. So waste treatment facilities were mentioned is just one example, of course, of major infrastructure, typically in the through project finance transactions. And what we see is that much of that industry is still largely a dollar structured sector, because host governments tend to take on the exchange rate risk. So that's what project finance lenders require, and therefore the exchange rate risk tends to sit with for example, utility off-taker. So that is, and of course, if a project has a dollar guaranteed revenue base because of a government guarantee, for example, backing up a waste treatment plant project finance structure, then the requirement for debt will also be in dollars and not in local currency. So from our perspective, it's still very much driven by microfinance, SME finance, little pockets of energy finance in the off-grid sector, but especially the bigger publicly backed infrastructure project finance type transactions tend still to be in dollars. Although in Africa, for example, recently in Botswana, in Ghana, Kenya, you see a shift also from governments where they say we are no longer necessarily taking the exchange rate risk and requiring that developers and lenders manage it, which is these days all possible, because that's was our story. Every dollar of finance, every impact dollar of lending that is provided today can also be offered in local currency. There are no more any restrictions in terms of volumes, tenors, or currencies that can be covered in local currency. So that's certainly not the constraint, and generally the constraint sits on the demand side, not on the supply side. So yeah, I don't know if that clarifies a bit.
No, definitely. Thanks for the detailed answer. So great. I think we are approaching slowly the 10-minute mark for closing the session. So I would welcome questions from the audience to the speakers, of course, and we can redirect those accordingly. So please don't hesitate to enter into the Q&A. I can see that. Yes. So for now, there's no questions yet. So maybe if there are none, I also have a couple to add to that, but okay, so we have, okay, we did have a question that was in fact answered by Per at the very beginning. So I'm just waiting if there are any other questions. Yes, there is one. So okay, this is for me. So how come? Okay, so it's in the targeted SDGs by those funds. There's a question by Arvind on how come SDG 4 and 8 are the highest and not education and health. So I'll go back to my presentation. That's the question, Arvind. Yeah, so basically what we see again, I mean, there is a lot of flows to microfinance. There's a lot of funds in the sample, which are microfinance funds, and their approaches to doing microenterprise financing, working capital loans, household needs to meet those needs is very much inclined to favor SDG 1, no poverty, SDG 5, SDG 8, or the typical types of investor approach through these funds. And that's what's also reflected in the survey results. So a lot of these funds who have a bulk of their volumes to microfinance, unsurprisingly will, you know, map their investments to these specific SDGs. And since we see that other sectors are not, you know, I mean, not yet in terms of volume-wise close to the microfinance levels, it's natural that other SDGs like the ones Geneviève would look at with their investors on water is not part of the top 5 to 10 SDGs targeted. So I hope that answers your question. There's another question from Christelle, and I think that's for you, Per. So from your point of view, do you think that funds don't do more local currency due to limited hedging options and cost of hedging?
Well, I think that hedging options these days should not be a constraint. As I said earlier, between us and MFX, I mean, you have commercial banks, of course, but where commercial banks are falling short, TCX and MFX combined can work with basically any impact lender to provide any kind of currency derivative required. So that there shouldn't be, or there isn't any limitation anymore on hedging options. Those can be made available. The cost of hedging, the very general response to the cost of hedging is that borrowing in local currency is empirically not more expensive than borrowing in dollars and taking the currency risk. So if you look at, if you take TCX as an example, which we like to do, we've supported over $10 billion equivalent of local currency loans, many thousands of deals over 70, 80 currencies globally. And on average, we can say that the difference in interest rate between a dollar loan and a local currency loan is only marginally, and I'm talking about 1% or so, higher than the combined depreciation cost of all these currencies. So in expectation, on average, on a very large statistical pool, which is the pool of hedges that we've performed, you can see that the difference in interest rate is marginally higher than the depreciation losses that we compensate for. So if you look at it from that perspective, it means that on average, in expectation, you pay a very minor premium, the 1% I mentioned, to be completely protected, to run no volatility, no unpredictability, no shock risk, nothing. So we like to use it because it's a hard empirical fact to show that local currency is not more expensive than hard currency. But that's on a portfolio basis. The issue is, of course, for any borrower in a specific moment in time, looking at a specific currency for a specific loan, may have all sorts of different inputs and thoughts. But generally speaking, you cannot say that hedging comes at an expense. You could even argue that hedging is, in fact, comes for free, because in return for being hedged, you also eliminate all sorts of intangibles. You don't have to reserve for shocks. Your financing terms over time should improve, et cetera, et cetera. So that's a generic story. We understand that in an individual case, it's much more complex than that response. I hope it helps.
Thank you, Per. Yes, I think you answered Christel's question. There's another one.
Yeah.
Okay. Do you see it? Yeah. Per?
Yeah, I see it, Ram. And of course, that is the perfect response to that very generic story I just told. And it is true that for a certain borrower in a certain segment, in a certain country, facing a choice between local currency and hard currency, he has no business with that very general story. He just he's looking at that single situation, and he may, and this is what happens very often in practice, he may decide to say, yeah, I believe that the local currency loan and in the background the hedge is correctly priced for the risk that I'm taking. But for me as a borrower to make a decision to borrow for 4 years at the dollar and 8% or local currency 16%, I'm happy to take that risk and to speculate. I'm going to borrow in dollars anyway and hope that the currency doesn't depreciate too much, because then I'm saving on my interest cost. That's a gamble, which may go horribly wrong, or it may turn out well. I think what the question here is should policymakers do something to make it less attractive or less tempting for a borrower to speculate? I think that's a great question. And this is why we do believe that in certain circumstances, it is justified to subsidize the cost of local currency, because if you can reduce a little bit that interest rate differential so that you reduce the temptation or the incentive for a borrower to speculate by dollars, you'll be increasing or persuading borrowers, and also lenders will have an easier decision when talking to their borrowers. You make it easier for both parties to opt for the local currency alternative and not speculate, rather than take the dollar alternative, which is riskier, because you don't want too many borrowers doing that, because if everybody does it, you're building a weaker sector, if it's the energy sector or the water sector or whatever sector, and it's the suboptimal choice for the economy as a whole. So I think for policymakers, that is a real that's an opportunity or a challenge or an issue or whatever you want to call it, to look at and to think about whether it is justified to do that in certain circumstances. And definitely something that we have been working on recently with the European Union and other sponsors, and are looking at currently for certain sectors.
Thanks again for the detailed answer, Per. It's very interesting, this type of different stakeholder, perspectives. So we are right on time, 1 hour. Maybe we can just wrap up. I wanted to really thank all of the participants in the session. Also the three speakers. Obviously, it was a very nice exchange. I hope it was a useful talk for the industry. The report is available, of course, and don't hesitate to let us know what you would need to see Tameo producing through these surveys. Anything else that's needed to be added in terms of impact, looking at the impact performance of these funds, or things that would be really useful for you in your business operations and that would make the sector to move forward even more rapidly. So we are all ears, and that's, I think, sorry, my light is so a bit in the dark, so I think it's time to wrap up. But thanks to all of you, and again, available by email for whatever questions you have.
Thanks, everybody.
Thanks so much, Ram. Thanks, everybody.
Thank you.
Thank you. Bye.
Bye-bye.
Bye, everyone. Bye.
Bye.